So the question reads, Riziki Insurance Company Limited was incorporated in the year 2019. The company deals with different classes of insurance. The following trial balance was extracted from the books of account as at 31st December 2021. So property, plant and equipment, provision for depreciation, investment in government securities, gross premium received from direct clients, motor vehicle, fire, gross premium received from agents, motor vehicle, fire, commission on insurance accepted, motor vehicle, fire, commission on insurance ceded, motor vehicle, fire, sundry, receivables, bank balance, director's fees, insurance premium paid, motor vehicle, fire, and earned premiums as of January, motor vehicle, fire, claims outstanding as of January 2021. Motor vehicle, fire claims paid, legal costs on claims for motor vehicle and fire, sundry expenses on motor vehicle claims, provision for bad and doubtful debts for motor vehicle and fire, insurance, management expenses for motor vehicle and fire, investment income, premiums returned for motor vehicle and fire profit and loss account, claims intimated and outstanding on 31st December amounted to 750 for motor vehicle and 80 for fire insurance, and earned premium is maintained at 80% and 50% of net premiums received for motor vehicle and fire insurance respectively. Investment allowances have been agreed with the Commissioner at 1.2 million for the year. Investment income analysis, interest received from government securities, interest received from local banks, dividend received from a Ugandan company, dividend received from a local company, fees paid to investment managers amounted to 750,000 for the year. Required taxable income or loss for Riziki Insurance Company Limited for the year ended. Then compute the tax payable. So for Riziki Insurance Company Limited. So, gross premiums received from direct clients. So gross premiums. So gross premium from direct clients we had added. 3 million is received from motor vehicle and 2 million from fire, so the total is 5 million 500. We had done that. Then there is gross premium received from agents. So received from agents. So gross premium received from agents, motor vehicle is 2 million, fire is 1 million 200, so that's 3 million 200. So that's gross premium. Now this gross premium will need to be adjusted. So this total is 87. So total is 87. We can adjust for returned premium or premium paid on reinsurance. So there is premium returned down there. Motor vehicle is 800 and fire is 700. So you can say less. Returned premium. Returned premium. So premium was returned of 1500, so we return that. Would be that. Then kuna reinsurance premium paid. So reinsurance premium paid for motor vehicle is 400, for fire is 150. So we also lessen reinsurance premium. So reinsurance paid is 550 was paid on reinsurance. You adjust for that. We also adjust for an earned premium. There's an earned premium brought forward. So right now it's due, so we'll add it. So there's an earned premium. It was unearned by last year. It was unearned by December. Now it should be due. It's like a prepayment, prepaid premium that have been received. So this is 48 plus 25 will give us 73. And earned premium in January 73, so we add that. So that gave us how much?
13,950.
13,950. That is income from premiums. Then we can get income from, other income. So property, plant, there's investment in government securities, that's not an income, gross premium. There's commission on reinsurance ceded. So bring in commission on reinsurance. So commission on reinsurance ceded, your 700 plus 300 is 1 million. Commission on reinsurance ceded is 1 million. What else? We have investment income down there. Now, investment income, we've been given the breakdown. The breakdown is in note 4. So investment income analysis, interest received from government securities, you can convert that to gross. We said there's already a withholding tax of 15%. So what we have there is minus 15%. So what we have is 85%. So you can convert back to gross by getting 2040. We divide by 85. We multiply by 100. And that gives us the gross interest. Why did we not consider note 2 as an earned income carried out note 2? No, note 2 is simply giving you information. It's telling you to get that value of an earned income, you get 80% and 50% of net premiums received for motor vehicle and fire insurance. They're just explaining how that figure was arrived at. So to get an earned income, an earned premium, note 2 is simply saying get 80% of the premiums received by motor vehicle and 50% of the premiums received by fire. That's just information. So it says an earned premium is maintained at 80% and 50% of net premiums received for motor vehicle and fire. So it's talking about the same thing. It's only explaining how the figure was arrived at. How the figure of an earned premium was arrived at. So we were doing investment income. So investment income we start with interest from government securities. Government securities, and the gross amount here, so investment income, interest from government securities. So the figure is 2040. We divide by 85 because it's minus 15% times 100. So that gives us gross of how much? 2400. So gross is 2400. I'll just put it here in the meantime because there was an expense, isn't it? Was there an expense to go with investment income? Ilikuwa na expense ama ilikuwa na? Apparently there isn't. I'm trying to look at any fees paid to investment managers or something like that. Yes, it is. Note 5. There is fees paid to investment managers amounting to 750. So let me just put it here after adding, we'll deduct the fees there. Then the next one is called interest received from local banks is also net. So there's interest from local banks or just interest from banks. We need the amount grossed up. So the gross would be 760.5. You divide by 85, you multiply by 100. And you get how much?
894.
This is 894.
0.706.
894.706. So 894.706. Dividend from a Ugandan company is not taxable in Kenya. It accrues from outside. Dividends from a local company withholding tax of 5% is the final tax. So we add this and we get a total of how much?
254.
254
2544.
is 2544.
Yeah.
2544
4706.
706. Then less fees paid to investment managers. So fees to investment manager.
No, that is already less. That is 30.
Oh, you've already lessened. So this total is how much before you lessen fees?
3290.
So E after to me lessen fees it itakuwa 2544.706. Before we lessen it's 3294. 3294. Fees from investment managers is 750. So we lessen 750 here. So the difference is that. So that's investment income. Commission on reinsurance ceded, that we've already put 1 million. Sundry receivables, bank balance, director's fees, the reinsurance premiums paid and earned premium, legal costs, sundry expenses, management expenses. We don't have any other income. And earned premium, investment allowances, we don't have any other income. So this will be our total income of how much? That is what we had by Gapi? 494. 706. Is that the same we had earlier?
We did not add. Just
Or the other time we did not add? Okay, so less allowable expenses. Less allowable expenses. The first expense we bring in is claims paid. Claims paid, motor vehicle is 2770, fire is 2110, so that gives us 2880. 4880, sorry. So 4880 is claims paid. Now these claims will need to be adjusted. Look at note 1. Claims intimated and outstanding on 31st December amounted to 750 for motor vehicle. So that's claims intimated and outstanding at the end of the year. We can get claims outstanding at the beginning of the year just under unearned premiums. These claims outstanding in January. Motor vehicle is 1,100,000 and fire is 840. So we'll say claims outstanding. In January. So claims outstanding brought down will be 1940. So we subtract that. Then you have claims outstanding. At the end of the year. Claims outstanding at the end of the year is given in note 1. 750 plus 480 will give us how much? 1230. So we add 1230.
4170.
Do we have recoveries from reinsurance? I didn't see anything like that. Hakuna reinsurance recovery. So this is just the expense of how much?
4170.
4170 is the expense from claims. Commission on reinsurance accepted. On reinsurance. Commission on reinsurance accepted is 800. That's commission on reinsurance accepted. There is director's fees. Director's fees of 495. Director's fees is 495. There's legal costs on claims for motor vehicle is 280, for fire is 130, giving us a total of how much? For 20? For 10. So legal cost is 410. Legal cost on claims is 410. Sundry expenses on motor vehicle claims. So we have sundry expenses. Sundry expenses on motor vehicle claims is 220. Provision for bad and doubtful debts is not allowable because that is a general provision. So the examiner has to see it is specific. So provision for bad and doubtful debts is not allowable. Management expenses will be a total of how much? 830. Yes. So management expenses, we put 830. Management expenses is 830. Then we have investment allowances in note 3 have been agreed, so you don't need to calculate. So investment allowances is 1.2. Is 1.2. So that should be all. Allowable expenses should be that, and the difference should give us income. This is the allowable expenses is 8125. So that income is how much?
9369.
706. This is taxable business income. That's the first part of the question. Then we are required to calculate the tax payable. So we'll say corporation tax. Corporation tax liability. Corporation tax liability will be 93,69,706 multiplied by 30%, and that gives you how much?
28.
28.
109.
8109.
11.8.
Like that, then you lessen the withholding tax. So withholding tax on investment income. So we have interest from government securities. So interest from government securities is 2.4 million, you multiply by 15%. And that should give us how much? 360,000.
Yes.
So deduct here 360,000. Then we have interest from banks. So interest from banks is 897,706. We multiply by 15%. Withholding tax rate.
89.
The gross amount 897,706.
Number 894.
Ilikuwa 894. Sio 897. So 894, 706. If we multiply by 15%, we'll get withholding tax of how much?
134, 205.9.
How much?
134.
134.
205.9.
So the difference should give us corporation tax pair.
Twenty-three 16.
2316.
705.9.
705.9. So our next topic, we want to look at long-term contracts. So the topic is called property developers and contractors. This is for long-term contracts. Property developers and contractors. You can introduce this and say the following. A contract is an arrangement. A contract is an arrangement. A contract is an arrangement specifically negotiated. A contract is an arrangement specifically negotiated. A contract is an arrangement specifically negotiated for the construction of an asset. A contract is an arrangement specifically negotiated for the construction of an asset. For the construction of an asset or combination of assets. For the construction of an asset or combination of assets that are closely integrated, or interdependent, that are closely integrated or interdependent, that are closely integrated or interdependent in terms of their design, technology and function, in terms of their design, technology and function, in terms of their design, technology, and function, or their ultimate purpose, or their ultimate purpose, or their ultimate purpose, or use, or their ultimate purpose or use. Then you say a contract may be negotiated for the construction of a single asset. A contract may be negotiated for the construction of a single asset. A contract may be negotiated for the construction of a single asset, such as a bridge. A contract may be negotiated for the construction of a single asset, such as a bridge, building, pipeline or road. A bridge, building, pipeline or road. It may also deal with the construction. It may also deal with the construction of a number of assets. It may also deal with the construction of a number of assets. It may also deal with the construction of a number of assets that are closely interrelated. It may also deal with the construction of a number of assets that are closely interrelated or interdependent, that are closely interrelated or interdependent, that are closely interrelated or interdependent in terms of their design, technology and function, in terms of their design, technology and function, in terms of their design, technology and function, or their ultimate purpose, or their ultimate purpose, or their ultimate purpose or use, or their ultimate purpose or use, e.g., construction of oil refineries, e.g., construction of oil refineries, construction of oil refineries, and other complex pieces of equipment, construction of oil refineries and other complex pieces of equipment. Next, abetting contract revenue, then we say revenue is measured at the fair market value. Revenue is measured at the fair market value. Revenue is measured at the fair market value of the consideration received. Revenue is measured at the fair market value of the consideration received or receivable, of the consideration received or receivable. The measurement of revenue is usually influenced. The measurement of revenue is usually influenced The measurement of revenue is usually influenced by various uncertainties, that depend on the outcome, of future events, Hence, the estimates may need to be revised. As events occur. And uncertainties are resolved. Next, abetting contract costs. Then you say the contract cost can be categorized. The contract cost can be categorized as follows. The contract cost can be categorized as follows. A, costs that are related directly. A, costs that are related directly. A, costs that are related directly to a specific contract. Costs that are related directly to a specific contract. Costs that are related directly to a specific contract. B, costs that are attributable to a contract activity. Costs that are attributable to a contract activity in general. Costs that are attributable to a contract activity in general and can be allocated. Costs that are attributable to a contract activity in general and can be allocated to the contract and can be allocated to the contract. And C, such other costs as are specifically chargeable. Such other costs as are specifically chargeable to a customer. Such other costs as are specifically chargeable to a customer under the terms of a contract. Under the terms of a contract, such other costs as are specifically chargeable to a customer under the terms of a contract. Next are heading revenue and expense recognition. Revenue and expense recognition. Revenue and expense recognition. Revenue and expense recognition. Then you say where the outcome of a contract can be estimated. Where the outcome of a contract can be estimated. Where the outcome of a contract can be estimated reliably. Where the outcome of a contract can be estimated reliably. The contract revenue and cost. The contract revenue and cost can be recognized. The contract revenue and cost can be recognized. The contract revenue and cost can be recognized by reference to the stage of completion. By reference to the stage of completion. By reference to the stage of completion of the contract activity. By reference to the stage of completion of the contract activity. This approach is referred to as the percentage. This approach is referred to as the percentage of completion method. This approach is referred to as the percentage of completion method. Is referred to as the percentage of completion method. Then you say the stage of completion. The stage of completion of any contract can be determined as follows. The stage of completion of any contract can be determined as follows. So the stage of completion of any contract can be determined as follows. So you can have an approach like A. This approach says costs is certified. Cost rate certified divided by estimated total cost. Then you multiply by 100. That's one way. Another way you can get value of work certified. Value of work certified you divide by contract price, multiplied by 100. Then C, you could have units completed to date. Units completed to date to divide by estimated. Total units to produce multiplied by. So the first two methods are the most common. The third method is not very common, but it could apply. You never know. Next, subheading determination of estimated contract profit. Determination of estimated contract profit. Determination of estimated contract profit. When you say the estimated profit of any contract, the estimated profit of any contract, the estimated profit of any contract can be determined as follows. The estimated profit of any contract can be determined as follows. The estimated profit of any contract can be determined as follows. So you have contract price. Cost to date certified. Estimated cost of completion. And using the three methods, you get percentage of completion. Then profit recognized. X you multiply by that percentage of completion and you get the taxable profit. You multiply that by that percentage and you get the profit for tax purposes. So I'll forward a question to Love and then you can share it in the group. So this should be December 2012, question 2. Should be our first illustration. It's called, I'll forward May 2012, then December 2012 also. I forwarded May, now let me forward December 2012. Okay, so we'll start by looking at May 2012 question 2 is called Ujenzi. May 2012 question 2A says Ujenzi Contractors is a firm engaged in the property development business. During the year ended 31st December 2011, the firm secured 3 construction contracts, namely X, Y, and Z. The firm computes taxable income from contracts on the basis of percentage of completion method. The information relating to the 3 contracts is as follows. So there is contract X, Y, and Z. Contract price, cost of work certified to date, estimated cost of completion, additional information. The total allowable expenses for the 3 contracts amounted to 500,000. The firm allocates expenses on the basis of contract price. The firm received interest income on a housing development bond amounting to 960,000 during the year. The firm also received dividends from investments amounting to 1360,000 gross. Required determine the following for the year ended: taxable profit or loss for each contract, total taxable profit or loss for the firm, tax liability for the firm. So we'll prepare a statement of taxable profit for each contract. For the first one, we only want for the contract, so there is no point. We are not preparing a whole statement as such. That will be for these are contracts. So this is contract X. Then now for contract Y. So this is Y, and the final one is Z. So we'll start by getting the contract price. For X, I think is 1.2. The contract price is 1.2 million. $1.2 is the contract price. Then you lessen cost to date. So today, what has been certified is 400. Then estimated cost of completion. Estimated cost of completion is that. Then we also deduct allowable expenses. There are allowable expenses which will be allocated on the basis of contract price. You get that in note 1. The allowable expenses for the 3 contracts amounted to 500,000. The firm allocates expenses on the basis of the contract price. So I'll put a working note here for allowable expenses. Okay, let me just put it here. Note 1, for allowable expenses. You allocate on the basis of the contract price. For example, for contract X. For contract X, the contract price is 1.2. The total price for the contracts will be the contract price for X plus the one for Y plus the one for Z will give you a total of 5 million. Because it's 1.2 plus 1.8 plus 2 million. So the total is 5 million. You apportion proportionately, then you multiply by allowable expenses. So that should give you 120 for contract X. So allowable expenses is 120. So that will give us contract profit. $240. Then you use percentage of completion method to get the profit recognized. The profits recognized is what we need for tax purposes. So percentage of completion method will get, so profit recognized. So profit recognized, you get cost to date. Cost to date is 400. But by the time they finish, the total cost will be 840. You can multiply by 100 to get the percentage fast, or you can multiply directly by the profit of 240. So you can multiply directly, or you can get the percentage of completion fast, and then use that as part of profit. And you get how much? 114. So 114.28 29. How many 28 ngapi? 286. Okay, so this is the profit recognized. That's for contract A. I want you to do the same thing for contract Y and contract Z. So that would be the taxable profit using the percentage of completion method. And that's for one contract X. Now you can get for the others in a similar way. you can get for contract Y and Z. So for Y, the contract price is 1.8. Cost to date is 720. Estimated cost to complete is 560. So this is 1280. Allowable expenses is 180. So that gives us profit of 240. How much is recognized? 191.25. Then contract Z. The contract price is 2 million. Estimated cost to date is 1.2. This one is 200. This one is how much is recognized?
342.857.
So that answers part A,
342.
342.857. That's Roman 1. Roman 2. Total taxable profit or loss for the farm, the whole farm. Total taxable profit or loss. So we can get first the contract profit by simply adding. So X is 114.286, Y is 191.25, Z is 342.857. The total contract profit is how much?
648.393.
648.393. Then there is information in note 2 and 3. Note 2 says the farm received interest on a housing development bond amounting to 960,000 during the year. And note 3 says the farm also received dividends from investments amounting to 1360,000 gross. Now, dividends from investments is only taxed once. Withholding tax is final tax of 5%, but dividend from housing development bond will be subject to tax. But now that dividend was indicated in brackets to be gross, the examiner did not say anything about interest, so it is implied, or it is safe to assume that interest must be net, because if it was gross, the examiner would have said, he has told us dividends are gross, so we'll assume interest is net and convert that to gross. So interest from housing development bonds, so we have interest from housing development bonds. So the gross interest is going to be 960 divided by 85, because withholding tax is 15%, 10 15, and we get how much?
169.412.
169. How? This is 960. It can't give you 169. We met after 15%. So you get 960, you divide by 85, you multiply by 100, and that gives you 1129. 1129.411 or 412. Then you get the total taxable income by adding the two. You add 648. You get 77.805. So this is total taxable income. That was Roman 2, total taxable profit. Then Roman 3, they want corporation tax liability. Corporation tax liability will be 1777,805, multiplied by 30%. That would be 533, 341.5 less withholding tax. We have interest. Interest from housing development bonds would be 1129,412. You multiply by 15%. So deduct 169, 411, 8. How, Sharon, there's a working output, working two. I showed exactly how you get the percentage of completion. You take the cost to date, you divide by total cost to complete. I'll put for X, and that applies for every other contract. 400 over 840 times this profit will give you that. And you apply the same for Y and Z. It's in working note 2. I put a working note there. Then we look at May 20, not May, but December. December 2012, I sent the two questions. December 2012 is part C called Sakata Contractors. So the question reads, Sakata Contractors Limited has been in the construction business for many years. The following information relates to one of the construction contracts for the year ended 31st December. So opening balances in January, materials on site, accrued wages, rent prepaid, plant written down value, transactions during the year with materials sent to site, plant purchased, wages paid, inspection fee, subcontractors fee, consultancy fee, materials sold at cost, cash or labor, head office expenses, depreciation is a provision, rent paid, non-contract related, other expenses allowable, value of work certified in the year, cost of work uncertified, cash received from client, balances as at the end of the year, material on site, wages accrued and rent accrued, additional information, wear and tear allowances is at the rate of 12.5%. The company recognizes 2/3 of annual profits when they arise. So this company does not use percentage of completion method. They recognize 2/3 of the profit. 3, any contract losses are recognized in full in the year of their occurrence. Required contract profit or loss for the year, then taxable profit or loss for the year, assuming that there were no other contracts with a significant degree of completion. So for this one, we want to prepare a T account called a contract account, and you will use idea. We discussed costs, contract costs earlier, and we said you have direct costs. So in a T account, you only debit direct cost of a contract. Then you have a cost that can be attributable to a particular contract. So you find a way of apportioning. Then you have any other costs which can then go to a P&L like this one. So costs that are not direct will go to a profit and loss account. Direct costs will go to the T account of the contract. So I'll prepare a contract account here. So this is December 2021. Not December 2021, but December 2012. Sakata Contractors. So prepare a T account for the contract. So direct cost would be like materials, material cost. And material cost in our statement, there are several items. For example, we have material on site, opening balance is 30,000. Then we still have additional material sent to site of 100,000. Then we still have balances at the end of the year. Material on site by 31st December of 30,000. So you can look for the actual cost of materials by preparing either a T account, or you can work it straight without a T account. So let me put a T account for materials. So we in January, we have an opening balance, so balance brought down. In January, it was 30,000. $30,000 is balance brought down. Then there's the additional materials sent to site. Okay, so you have additional materials from stores sent to site, another 100,000 you debit. Another 100,000 is debited from the store. Then you have material sold of 1,500, so you credit that. So you have material sales of 1,500. And that is all. Oh, and you put the closing balance. Balance at the end of the year is 50,000. So you also have balance, carry down is 50. Then you balance off this T account. So this is 130. The balancing figure you take to the debit of the contract account should be 78,500. That is what we debit here. Cost of material is 78. Alternatively, you could have just added, you would have said opening balance is 30,000 plus 100,000 minus 1,500 minus 50,000. You still get 78,500. So that's material. Then we have wages. We want to get wages cost. But even wages, there are a number of figures. So it will need adjustment. So we have accrual brought down at the beginning of the year. We have wages paid during the year of 8,000. Then you have wages accrued by the end of the year. So we have to determine also for wages. This is not two wages. So wages, I'll start with the transactions during the year of wages. Wages paid is 8,000. Let's say it was paid from the bank. I credit bank, I debit here. Wages paid. They paid 8,000. Then there's accrued, but in January, not in December. Accrued brought forward in January. Accrued wages brought forward in January, not December. So this will be a credit. It was accrued last year. It's being brought forward in January. So balance brought down for wages, accrued brought down is 2,000. Then you have an accrual now at the end of this year, 4,000. So you have accrued wages, carried down at the end of the year, we accrue another 4,000. Then we close that. So to the contract account, we take 10,000. Alternatively, you could say 8,000 minus accrued in January, 2,000 plus accrued at the end of the year, you still get 10,000. So that's wages. Rent prepaid. Now rent is not a direct cost. We said we'll only debit in the contract account only direct costs. So rent is not. They even tell you, if you check under transactions of the year, you'll see down there they're saying rent paid is non-contract related. Non-contract related is not a direct cost of the contract. Plant written down value is an asset. So you can only calculate investment allowance on that asset. So investment allowance on plant. So we'll take 10%, the rate of other, simply other assets. So plant opening balance is 20,000. That's the opening balance, 20,000. Then your plant purchased of 10,000, so you add an additional 10. Then you get 10% of that. So that would be 3,000. Investment allowance on plant is 3,000. Transactions during the year, materials sent to site, plant purchased, wages, kuna inspection fee, that's a direct cost. Inspection fee is 2,000. Inspection fee is 2,000. Subcontractors fee is 1,000. Subcontractors fee is 1,000. Consultancy fee is 3,000. Material sold, there's casual labor of 2,000. Casual labor is 2,000. Head office expenses is not a direct contract cost, so leave out that. Head office expenses. Depreciation is not allowable. Rent paid is non-contract related. Other expenses is also not a direct cost. Value of work certified is the payment they expect. So it means the architect had certified that they should be paid 120,000. So that's what you credit as income. You credit value of work certified by the architect or the contractee. So they're expecting a payment of 120 million because that is what has been certified. Cost of work and certified, that's like closing stock. It will be certified in the next period of work and certified. That's your closing stock. So this will be certified by the architect in the next period. So when we balance off this, we can get the contract profit. So we balance off this, it will give us the contract profit. Oh, there's something else, right? This profit needs to be broken down. So there's profit to recognize. which is only 2/3. That's what they told us. And two, the company recognizes 2 out of 3 of the total profit, so that there is a balance we carry forward. Balance carry down. So there's an amount they don't recognize. They only recognize 2/3, so they carry forward 1/3. This would be 140. 140. So the profit you get, you're going to split into two. 2/3 is what is recognized, and 1/3 is carried down as a balance because of prudence. Unasema 4,500. 4,500 is, then get 2/3 of that times 2/3. So 27,000. That, and this then is 13,000. So contract profit is 27,000. 2/3. Mesma 4,500. And where is the 500? I'm saying, where is the 500 in this breakdown?
2/3 of 4,500.
2/3 of 4,500 is 27,000. But if you add this, you just get 40,000. 27,000 plus 13,000 is 40. Where is the 500? So umesema 4,500. Ukiadd hizi unapata 40. So it's 26 something. So 4,500 times 2/3. This one is 13,000. That is what I was looking for. So 13,500. So that's the first part. Now the second part of the question, taxable profit or loss for the year ended, assuming that there were no other contracts with a significant degree of completion. So prepare another statement of profit. So statement of taxable profit. So you bring forward your contract profit. So contract profit from the other statement. So contract profit is 27. Then you lessen allowable expenses. All the other expenses you have left out because they were not direct costs. So we lessen allowable expenses. Like rent, You can prepare a T account for rent, but rent paid during the year was 8,000. So that paid during the year, I will put here. Rent paid during the year is 8,000. Rent prepaid last year, brought forward in January. It was prepaid last year. This year it is due. Last year it was a prepayment. Now it is due. So I add 4,000. Then rent accrued by the end of the year is another 5,000. An accrual by 31st of December. So that gives us total rent expense of 17. So that is rent. Then kuna nini? Kuna head office expenses of 3,000. Then there are other allowable expenses. Other expenses allowable is 2,000. Other allowable expenses. Or simply other expenses. It's 2,000. So we add this to get 22. So that gives us a profit of 5,000. As an assignment, you can try November 2019. November 2019 is question 4. It's called Benita Contractors. November 2019 question 4 is called Benita Contractors. You can try that as an assignment. Then we stop there. Yes? On Saturday? Yes. Yeah, if there's a holiday, most probably will not be meeting. So on Thursday is 20. Yeah, so the next class should be Saturday. We'll stop this first.